Well, hi guys, and welcome to our Pure Property Investment webinar. Essentially, what we want to do for this webinar is give our viewers what we deem as our 7 major fundamentals of investing in property and effectively how to invest strategically and make profits in any market at any point in time. It's not I guess, a system that we'd say is going to be foolproof, and it's going to be something that you plug in and all of a sudden you're doing it in every market. You make money and you can buy any property, and essentially that's going to turn profits. But what we realistically want to do from this webinar is give all property investors, whether they be new property investors or established property investors, seasoned property investors, those major fundamentals that we as a company follow when we're looking to source, secure, and negotiate properties in markets which we see opportunity within. So what I'll do is we'll go through that detail. We'll go through it in quite some specific points, and a lot of you might want to take that information and run with it, which is great because that's really the intention here. But what we'll also do within this webinar is walk through as a company how we plug that in, our process, and how we help property investors look to do exactly what we're working on, and going through those fundamentals and then taking the next step and sourcing and securing the right properties as per your specific criteria and your objectives, which is very important and is probably one of the aspects which probably should be established before you go and buy your next property. So I promise I'll get to that at some stage in this webinar as well, but if it's okay, we'll get straight into it. So effectively what we want to do, as said, is well, probably before that, I'll apologise. I'll go through just a quick disclaimer, which you've probably seen a million times over, but from our side, it's essentially to say that the information we provide in this webinar is general and advice, and it's not specific to anyone's probably pertinent details. So I'd always advise that if you are going to look to action and buy your next property, seek independent advice and make sure that's going to be specific to what you're after, and don't take anything we go through here as gospel per se, because it's quite general in its nature, obviously. So let's get straight into it. From our side, the 7 fundamentals of property investing, they essentially aren't necessarily what I'd say are necessary for every single purchase you make, but they give a very good guidance and a good background as far as things you should be thinking about before you buy that next property or pick that next particular state, and then therefore that suburb and even that property type, and making sure it's right and it's primed for growth, as opposed to just buying it because everyone else is buying in that market and you don't really understand much more than that per se. So if we look at what are some of those fundamentals, the number one we look at, and this is probably more, apologies, this is more probably specific to buyer sentiment, is real estate cycles. And I'm not going to go through the property clock and where things sit, but effectively what I might do is go through this graph in particular and talk about how certain cities and certain major cities more specifically probably reflect on this particular graph, and how different aspects of the market will deem to be showing different buyer sentiment and also the psychology of real estate cycles. So if we go through this whole cycle here, it basically goes from optimism through to optimism and everything in between. Now, what we deem optimism to be from our side, the market's going to pass through good growth cycles. It'll also pass through flat cycles and potentially downward trends over periods of time, and then at some stage typically move back up to an optimism or a growth cycle. Now, what are some of the cities and where do they sit right now? I'm not going to go through necessarily saying here's where each city sits and here's where you should and shouldn't be buying, but more so the psychology. And I'll give some cities as far as where we sit right now to give some examples, and probably more specifically and quite topically, Sydney and also Melbourne have probably gone through anywhere between 3 and 5 years worth of a very strong and sustained growth cycle, and most of the years between probably 2012 and 2017 have had double-digit growth in each one of those cities year on year for the last 5 years, and that has led from what was probably, and I think we have a pretty short memory, is that Sydney in particular from around about 2005 to 2009 had more or less no growth if you factor in CPI, and Melbourne wasn't too much better. There was some strong growth years and there was some flat years, but in general across that time frame it was relatively flat. But what had coupled with that is a few things that all played into the probably to the hands of Sydney and Melbourne in particular. Strong economies coming out of the GFC with relatively decent economies, relatively low unemployment rates, and then also we saw cash rates starting their downward trend, which ended up leading to where we got to a flat bottom of approximately 4% for interest-only investor loans, which is now creeping back up and probably seeing more of a normalised high 4s, early 5s% for the next few years. But that's been a trend of what we sort of deem to be optimism around about 2010, 2012, through to excitement, which was probably that really strong growth cycle of double digit, and essentially euphoria. And that was probably where I see a lot of speculative purchases happening in those markets, where people basically got on the back of other people's growth and bandwagon buying, because credit was cheap, it was easy to get money, and people thought that those cities were bulletproof because they're major cities, and you can't go wrong. Well, I probably would like to see that where if we fast forward to around about 2022, 2023, I think we're going to see a lot of prices in Sydney and potentially in certain markets in Melbourne as well, sit pretty similar to where they are in 2017, 2018. And I think ideally it's probably moving right now. We're seeing a couple of months back to back in Sydney in particular of flat growth, and I think that's going to lead to this downward trend. Not necessarily we're going to be falling off a cliff in those markets, but I do see that we're probably in for a good 2 to 5 years worth of relatively flat growth in each of those markets, coupled with pretty poor yields of mid 2s to mid 3% for freestanding houses. But if we look at other markets where opportunities do lie right now, probably markets which we see are probably more so just hitting their straps as far as optimism and opportunity within the starting of definitely green shoots in their economy, good strong population growth, as well as aspects which are going to lead towards better sentiment, which in turn will lead towards better opportunities in that growth cycle. Areas such as probably the freestanding housing markets in certain parts of Brisbane. Canberra has had a very good couple of years, and I think we'll have a good sustained 2 to 3 years left in it as well, and that's probably more on the back of good strong economy, pretty good optimism, good jobs, stable jobs creation as well. Hobart's having a good tear as far as a very small market's concerned, low vacancy rates, low stock available and high demand, as well as very good growth recently. I think Adelaide, very suburb specific, has probably had some relatively good numbers and it's probably got an okay 3 to 5 years ahead of it as well. But if we look further towards what probably maybe sits down towards this despondency, depression, and potentially starting to move into that hope phase, is probably in particular Perth is a pretty obvious one. Now, Perth coming out of 2014 was probably, since that peak of 2014, they're approximately 10% off that peak, so 10% drop since that peak of 2014. We're probably coming very close to a trough and a bottom of that market. However, I wouldn't say we're anything more than probably people buying there in rather than basing it on any true fundamental facts that are, and I guess those facts are there's a lot of stock on market and record numbers of stock on market. There is record levels of vacancy rates, and we're talking 8 to 10% in a lot of the residential markets. There's still some pretty flat interstate migration, so the demand that's flowing into that market as well as the economy isn't showing great signs just yet. So I think we're probably personally a good little while away, potentially 12 to 24 months away from seeing that optimism, and the optimism backed by fact rather than just people saying, well, it's cheap, let's buy into that market. But I hope that sort of gives an understanding of the fundamentals from the psychology of real estate and how that works and plays into it. So if we look at how that now plays through from the next phase and the next fundamental of what we look at when buying in essentially in markets, and what are some of the factors we need to consider. So the second part is the percentage of mortgage commitment ratios and how that affects the ability for people in those markets to pay more and essentially allow price growth to continue. And this is a good graph for me. Look, it's probably might be a little bit late as far as the data is concerned, because we can't get this data from our end immediate, so it's a bit of a laggard in its own way, but it's probably giving a good indicative rate of where the markets sit across the country right now and where the percentage of mortgage commitment ratios lie to the actual approximate average total weekly earnings. And if we look at probably what 30-year data suggests, for potential cities to grow or markets to continue to grow, we'll work off a sweet spot of approximately 30 to 32% is kind of the number that we like to see maximum of the percentage of income to mortgage commitment ratios. Now, what that means is essentially the percent of money that's taken home every week is going to be attributed to a mortgage repayment. And what we've noticed over the 30-year data that we look at is that if you get beyond that 32, even up towards 35%, the ability for people to pay more in those markets starts to become very limited, and that's going to put a cap to a degree on growth. Now, you might get a big tear, and you can see in this graph here that Sydney and to a slightly lesser extent Melbourne are sitting at around about mid-40s in Sydney's case and high 30s, potentially up to early 40s in certain markets in Melbourne's case, as far as a percent of mortgage commitments to household income. Now, it can get up there, and obviously in a frenzied market in which each of those two are, you're going to push higher. But from our side, the data would suggest that every rubber band effect will go upwards, and then it will probably restrict itself again into that next market, which you're seeing there in that those two markets there in particular, I think, are probably past where we see opportunity and probably going to retrace slightly until they get back into that comfortable band. But if we look probably a little bit further down that list, Brisbane, Adelaide, Perth, probably obviously quite cheap. They've still got some relatively high incomes in there, but areas such as Canberra, which has got the strongest income in the country as a per capita basis, to a lesser extent, obviously Hobart, Darwin as well has quite a strong income per capita. There's still some room and flex in each one of those markets. Now, it's not to say that this is the number that says, well, you know, all of a sudden now Brisbane, Adelaide, Perth, Canberra, Hobart, Darwin are all primed to buy in, but it is a number, a second, I guess, fundamental that we look at to say, is that mortgage commitment within what we deem to be an opportunistic market and opportunities to grow? Now, these are quite general, these numbers across large cities. Now, obviously within those cities, certain suburbs have better percentages than others. But generally speaking, we look at this to say that we want to look at markets which are probably sub 30 to 35%, specifically probably sub 32%, which allows more growth to happen in that market and the opportunity for people to essentially pay more. So if we go into probably furthermore into the third point of that fundamental is the economy and timing the economy and specifically looking at unemployment rates. Now, this is more of a general Australian unemployment rate. So it's seasonally adjusted. Now, this is obviously 2016 data, end of 2016 data. We haven't got updated data just yet for this graph, unfortunately. However, we're looking at what we see to be how this is going to be correlating to certain markets. Now, I'd look at this as a general map. This isn't state specific or even going into local government area specific, but it is something that is quite important, and it's pretty obvious. I mean, it doesn't take a genius to figure out that the more people who are gainfully full-time employed or actually seeking employment, then there's going to be more money in that particular economy or that particular suburb for people to earn and therefore pay more for property. And the health of that, typically, the health of the employment sector typically correlates quite strongly with how the performance over the long term, and it might be a bit of a lagger because more people employed typically takes people a bit more time to ideally save a bit more money in the background, but also banks to want to lend against that person. So that's an important factor too, is that it doesn't just mean that people can save more money and therefore have more money to pay for property, but banks are also going to really like people who are full-time employed and also have more money disposably based on what their income is to pay more for a mortgage. So an important factor that you should be considering when looking at your specific suburb or state that you're going to focus on is understand the unemployment factor and what trend that's on. And, you know, areas, if you look at the last 10 odd years, obviously you can see quite clearly just before the GFC, we're at a nice flat 4 odd %, and it was really quite rosy. It rose very quickly, but we also had our mining boom that happened and coincided with that GFC, which gave us a relatively decent buffer against a lot of that unemployment. But as that mining boom has now probably come to a bit of a crescendo and is now plateauing, we're seeing the, I guess, the transition into the services sectors and a lot of the more so the mainstream employment sectors, which we've always relied on, which is seeing a relatively decent downward trend. But there are still some headwinds from a national economy perspective from the unemployment state. But again, it's something that I think you should be considering when buying in a particular state or a particular market. So if we go into how that works, probably in a little bit more of a deeper level, the fundamentals of what you do and before you buy, the impact of wage levels, and this is probably another following on from that unemployment factor, is the impact of wage levels. If we look at this both in the public sector and the private sector, you can see quite clearly here from the public and private sectors over the last 20 odd years, we're looking at different markets and how they might potentially be affected. And again, this correlates to the unemployment side of things. But when housing or household incomes rise, there's always obviously the prospect of higher wage levels and resulting in more demand for real estate. And again, it goes back down to the fundamentals. If people earn more, if they have more money in the bank, then they're more confident and the sentiment is high to say, I'm happy to pay a little bit more for that next property. Or even investors might think, I'm now going to look at buying my first investment property or my next investment property. They also look at when income levels rise, you look at people wanting to upgrade to a bigger house or a more suitable or potentially desirable location as well. again, I'd say this isn't one of the only factors we look at, but it's definitely a determining factor. And you can start to see there's a bit of a picture here that allows you to think, well, it's not just one specific aspect, be it sentiment, be it unemployment levels, be it where each state or where each city sits on its growth cycle or growth trajectory, or even impact of wage levels. It's going to be a combination of things that we look at and that you should be looking at to make sure you get your data and your understanding of the facts right before you go and invest. Now I'll look at what I'd say probably one of the fifth fundamentals, and it's really quite pertinent as far as where the market sits right now, and that is the impact of interest rates and how they can affect each individual market. Now this is again about a 25-year cash rate graph, which talks specifically about the price of money, and if we correlate or overlay that into how the growth of certain markets has probably plateaued or grown or reduced or also potentially fallen down, it in some way, shape or form will correlate to the cash rate. Now the cash rate probably specifically obviously affects what you're going to be paying from an interest perspective as an investor if you're accessing credit to buy that property, both as an owner-occupier and as an investor. And we can see quite clearly here that we've come out of obviously the very, very dizzying heights of 87, 89 when we're talking 17, 18%, and that came down quite quickly. And then we saw a relatively sustained, probably 10 odd years, potentially up to 15 years of between that, and this is obviously the cash rate, not the bank's rate, so this is the RBA cash rate, but we're sitting around about 5% to up towards 7.5%, somewhere in that band for the best part of 15 years until the GFC. And then the GFC obviously came and saw that we cut our cash rates very quickly, but the economy was still strong, so there was obviously a little bit of a quick boost, and now it's plateaued down to this point where we're seeing around about that 1.75-ish, give or take, cash rate, which from all the economists that we look at and their data, we're probably going to see that number is going to be pretty consistently sitting there for the next, I think realistically, the next probably 18 to 24 months as a minimum. Now, that's not necessarily meaning that the consumer is going to be paying a flat rate of 4%, as obviously the banks need to make their margin, and depending on where the credit ratings, it's going to mean that money's either more or less expensive. There's a few more intricacies that go through that. However, when we look at that, we're also going to see different levels of now investor demand, and how the banks and APRA in particular are now going to be forcing certain markets to potentially not allow such easy credit, and we're seeing all of a sudden now a big disparity between owner-occupier loans and investor loans, and also a reduction in loan-to-value ratio percentages, as well as potential principal and interest versus interest-only commitments, and there's going to be a lot of different levers that APRA have enforced on ADIs as well as non-ADIs in the banking sector. So look, it definitely correlates, but it is something that I think we need to be fully aware of, that we're in a very cheap money market, and if you're buying in properties which are probably at the top end of their growth cycle and have a very low yield, and money has been very cheap for probably the last 3 to 4 years, it's now starting to become more expensive. So if you're relying on capital growth for your property to keep making you money and not really paying true regard or respect to the yield play, I think a lot of investors are going to be caught short because they're not necessarily thinking that, oh, well, money's cheap, it'll be cheap forever. You need to factor in how good is the cash flow on that property, pre-tax, pre-negative gearing, pre-depreciation, and don't factor that into your equations, because as we've seen, those factors are fully out of your control, and they will consistently be there. So always understand that cash flow is going to keep you in the market, and making sure that capital growth obviously over the long term is what you're going to get out of that market, but cash flow always needs to be understood, and it needs to be taken into consideration when the money markets are fluctuating the way they are at the moment. Now if we look a little bit further down the track, and probably the six fundamental that we like to look at from a suburb and a state specific aspect, which is going to put current but also future demand into the fold, and really bring that into something that has to be considered in the equation of when we're buying and what we're buying in those markets, is population growth, and not just necessarily population growth over a 1 to 3 year period, but over the long term. And as we stand right now, the data that we've only just seen released from CoreLogic is showing that as we stand, and we're sort of somewhere in that 2017 market, the population growth in Sydney, for instance, is the net migration into Sydney is actually at its lowest rate in 5 years. And now that's probably subject to a few things. One would be and deeming to be the price of housing. One would be deemed to be that the ability for opportunities in other markets and seeing more families and more people being couples, singles, seeing opportunities in other markets for more affordable lives and better quality of living. So 5-year lows mean that we're probably going to see a bit of a softening in the demand over the long term, or potentially over the short to mid term for that Sydney market. But conversely to that, Brisbane and also Melbourne are actually seeing, based on the data that's only just been released by CoreLogic, we're seeing that they're at their highest net migration into those cities in 10 years. Now, that's probably a little bit to do with the price of housing, as well as a little bit to do with the strength of the economy in those two relative cities as well. So what we see in this graph, and I'd probably just more speak specifically to it, is that we're looking at, if we look at Greater Melbourne and Greater Sydney in particular, and grey being 2016, green being 2031, and onwards and onwards, we can see there, I'm not going to go through it too much and labour on those points, but we can see that there's good steady growth projected for each one of those, and we're effectively looking at doubling the total population in the next 40 odd years. Now, this is obviously projections, and projections are projections, and I take them with a grain of salt. But if we look at the current data, Melbourne has had a very good population growth number intrinsic as far as interstate migration. Sydney has just seen a relatively flat year or two, and I think we're probably going to see that flow through the market over the next couple of years, where there won't be as stronger migration over the next few years, given house prices and economies across the eastern seaboards are quite tidy. But over the long term, population growth in each of those two major cities is very strong. Additionally to that, Perth and Brisbane both look very good also, and we're seeing good steady population growth projections in each of those markets. Now, Perth, I think, has still got a soft couple of years ahead of it, but I think over the long term, fundamentally, they've got a lot going on there, and they still obviously need to factor in a lot of the transition from the mining sector into more of the essential services and general economy sectors to be able to keep that population growth going. But I think Brisbane's got a very good story at the moment, given obviously they're at their highest interstate migration numbers for 10 years. They're very, very much in what I would deem to be an affordable period of their growth cycle. But also their cash flow. I mean, you can probably chase anything between 4.5% and 5.5% gross yields in a lot of properties, freestanding houses in that Brisbane or that Greater Brisbane market. I personally wouldn't be touching the apartment market at this point in time for the most part, especially in the inner city markets, just because of that supply issue. But I think of that freestanding housing market and how that's going to affect long term, I think they're in for a very tidy, sustained growth period. Adelaide has always been probably an underperformer in population growth, and I personally don't see too much changing. Now, there's a couple of big ticket items that are happening from an employment sector aspect, both in the negatives and the positives. You've got the Holden plant closure happening out in Elizabeth over around about 2018 or so, and that's going to obviously affect not only that particular plant, but also all the parts and manufacturing sectors that are going to affect that market. So I think there's going to be a flow on to around about 10 to 15,000 additional jobs that will probably be hurting there. We've got the subs contract and potentially the frigates contract that are going to allow for some higher end jobs that will be created in that market, but even at its peak, the projections are around about 2,000 to 4,000 additional jobs, which I don't think is going to influence too much on that population growth and also the economy too much there. So I'm not super bullish on that Adelaide market personally. Canberra will be a steady performer, but it's also obviously heavily tied to the public sector employment facet. So it will continue to perform, they will continue to earn good money, but it will also have its fluctuations, obviously, depending on who's in power, how much public employment is going to happen, and contracts that go ahead accordingly. And to a lesser extent, Hobart and Darwin, look, I would only be focusing personally on those major cities rather than anything on the edges, be it Launceston, Burnie and Hobart, etc. And Darwin in particular, definitely only focusing on probably the 10-minute inner city aspects, because once you get further out, there's a lot of spare space. Hobart's a little bit more naturally created a bit of an amphitheatre where there is very little availability within Hobart itself. So you can only go further out down the Derwent, probably down towards Brighton, which might mean that down there's more spread land, but closer in, there's going to be relatively moderate population growth, but they do have a natural restriction of land that can be developed, which is probably going to feed into its favour over the next 10 to 15 years. But Darwin in particular, focusing probably only on the inner city areas, and even then I'm personally not that big a fan of it, just due to the fact that the demand over the long term is probably not going to be there. Now, probably I'll get into this part, and this is probably going to be into a little bit more detail. This specific aspect of the seventh point of the seventh fundamentals of where each market sits in its growth cycle. And this probably sits, or probably if I reflect back on the first slide talking about consumer sentiment, or where the psyche of the investor in the real estate market really sits. Now, this is more the factual part and not just focusing on how do people feel, but what the data suggests over the last 10 years and where we're at in our growth cycle. So this will hopefully give you a really good understanding of where things are at right now and how you can translate that into certain markets. Now, if I look at Sydney firstly, and now this is obviously part of and brought to you by CoreLogic and their specific data, but if we look at Sydney and annual changes in Sydney dwelling values over the last 10 years, and I'm just going to bring up another slide, so I've got some notes on that side of things as well, but you can see quite clearly here that Sydney being in the red line, obviously, and we're looking at black line being national averages or combined capital averages. Sydney has tracked over the last 10 years, probably been an underperformer for probably between 2004 and 2009, as I said a little bit earlier. Then it's kind of been the determining factor, given us Sydney's the biggest city, then it's going to have a huge influence on the actual national averages. But you can see here in the last 5 years, it's had a very strong and steady, probably somewhere in the vicinity of 10 to 20% year on year for that last 5 years. 75% higher over the past 5 years, Sydney dwelling values, and they're unchanged over the 3 months to May of 2017, 11% higher over the past year. But one thing in particular we're seeing, and we're seeing probably the third month consecutively now, we've got this downturn, and this downturn here at the end, sort of around about that mid-2017 mark, is going to be, I think, something that's going to be more sustained, and we're going to get back down towards that level of 1%, possibly up to 5%, maybe a couple of years of negative growth, and that's going to be attributed to investor demand based on what is happening in the restrictions in the credit sector. And I think Sydney right now is probably looking like where we're at the end of the previous strong growth cycle of 2001 to 2004. I think we're going to follow down what we see back in that graph, but I think we're going to see a long sustained plateaued period. And I don't think we're going to fall off a cliff anytime soon, but I truly don't think we're going to see much of I guess any more of those 10 to 20% year-on-year growth cycles from 2018 to 2021, 22. And how does that sit when we look at Melbourne? I don't think it's going to be too similar, but I do think that personally Melbourne, as far as where we see this, again, this 10-year data brought to you by CoreLogic, is going to probably see us, it's been probably a little bit more of a steady growth period. Again, good numbers, probably not as good as Sydney per se, but we're probably seeing something that's going to, again, be, I think, maybe 6 to 12 months behind where Sydney will start on this downward trend, but I think it's just at the start of where we see this downward trend into probably more of a sustained flat cycle again as well. So Melbourne, personally, we see is probably going to be going on this slightly downward trend and probably normalising around that 1 to 5%, potentially a couple of years of small negative growth over the next 3 to 5 years. So the yields, as well as how the growth has been in that market over that time, I think are going to affect that long-term growth. And that's probably why right now in the market, Sydney and potentially Melbourne, not necessarily our desired markets, and I don't think we're going to see the best results over the next 5 years in those particular markets. Further afield and looking at certain markets which we see probably a better short to medium term horizon in. Brisbane's one of them. I think the economy is an aspect which needs to still turn a corner. I don't think it's fully hit its straps, and I think we've probably still got a good 1 to 3 years of different aspects and filtering through the state economy that are going to feed to better jobs creation, higher wages, and continue to push in that net migration into state, into Brisbane, which will continue to push up the demand. But we can see that Brisbane, if we look at the 10-year data again, it had a good strong run, which was probably partly on the back of Sydney and to a lesser extent Melbourne having a very strong run back at that 2001-2004 timeframe. Brisbane had a very strong net interstate migration back then, which coincided with Sydney being unaffordable and Brisbane becoming much more of an opportunistic market, and their economy was performing relatively well and it continued to grow. And we saw that obviously in this red line here. We can see that Brisbane has had a very good previous probably 5 to 8 years. However, since the GFC and probably the downturn in the mining sector, it's had to transition, and its transition has been slow. It hasn't been a horrible performer. We're probably talking about between 1% and 4% over the years. However, it is something that we see has to be probably sustained, and we see probably a good 3 to 8% year-on-year capital growth, probably for the next 3 to 5 years. But the good thing with that market also is that there is good yields to be had. So the cash flow, even when we get to more expensive cash markets, is going to be solid, and that will also allow us to hold properties through longer periods of time without being affected by negative cash flow. Probably moving on from Brisbane into the next market there being Adelaide, and I've already spoken probably briefly about Adelaide and how it's looked over the last few years and what's ahead of it from a headwind perspective. I think what is in stage or in store for Adelaide at this stage is probably going to be more of the same. That's going to be relatively modest growth, and that's coupled with a few headwinds from the economic sector, but also when we look at that net migration in and out of Adelaide, we don't see much additional pressure. Maybe a little bit in that more in-demand markets, in those inner eastern markets closer to the coast of the Glenelgs and such, sort of, which are naturally bordered by the city and have very little available stock, and probably going to be those more affluent markets which will perform okay. However, cash flow in those markets still doesn't sit fantastic, in my opinion. We're probably talking 3.5% to 4% gross yields, which for some people might be fine, but for me, I like to chase a little bit better than that if I'm going to hold a higher priced asset and rely on growth over the long term. And look, from our side of things, Adelaide's always been probably a relatively long-term historical underperformer. I don't think much is going to change in that market over the next 5 to 10 years based on the population growth numbers that are coming through. As well as probably what's happening in the economy and the net migration in that economy as well. So that's probably our take on how that Adelaide market sits. Now, if we look at Perth, it's quite an interesting graph over the last 10 years. In Perth, in particular, you can see that towards the back end or mid 2005, 2006. Had some amazing years, and we're talking some years were sort of around that 30, even 40% in certain markets of growth year on year. Now, obviously, that's not sustainable, and it wasn't sustained, but that was really at the start of that mining boom. And that coupled with a couple of things. Now, we can see in the graph here that when regards to when we saw the GFC, we saw a very, very high spike, but are also really plateaued hard on the news of the GFC and how people thought that might actually affect things. However, that had a bit of a rebound, but since that rebound, we've really gone into what we see as what people thought was probably going to be a steady growth cycle, which then therefore was coupled with that mining downturn, which happened around that 2013-14 timeframe, where a lot of the construction of these mining sector jobs finished and they went into their production phase, which obviously meant a lot less jobs and a fair bit less demand. So those higher paying jobs, which were boosting up property prices in there, are really starting to peter off. They've seen a very soft migration and demand for their housing, which in turn has led to this minus 10% over the last 3 to 4 years. And we see that that's probably coming to a bit of a bottom, and it's bottoming out now, but I think it's probably got a year or two left before they really transition to more of a stronger economy, not necessarily centrally based on the mining sector. So opportunities do sit in that market, and as we saw in that population growth market, population growth chart earlier, I think the long-term picture and the long-term growth for population as well as their economy looks okay, but it's all about timing it, and I don't think necessarily based on the days on market as well as the vacancy rates, I don't think the time is probably ideal just yet, but it will be an opportunity market in the next few years to come. So keep an eye on that market, and I think really focus on those areas which are probably going to be more in that, focused on the demand for those white-collar jobs, the employment sector that's going to be within that 20 to 30k maximum radius, and obviously close towards those rail transport hubs and potentially infrastructure schools, and also the coast always seems to provide a better outcome than those 20 to 30 minute inland suburbs of the Perth market as well. We'll look at Hobart, and Hobart's again a very interesting graph when you look at how it performed over the last 10 years, and you can see this graph here on the red line. It had a massive couple of years, probably coupled with the 2001-2003 timeframes, where there was a very strong flow on, and part of that was due to what happened in the probably the tourism sector, as well as a few other aspects of the services and agricultural sector, which led to high demand in that early 2000s. but obviously came right off the boil, and since then, around about GFC time, it's really been quite a perennial underperformer up until probably the last year and a half to 2 years, and I think we're seeing a nice transition now into the services sector. The Chinese tourism dollars really flowing through to the Hobart market in particular, and that looks like it's projected to do quite well over the next 10 to 15 years. And also the supply, they just haven't built in the same levels that we've been able to build in some other cities, so therefore the supply that's been created over the last 10 years has been relatively minimal, and they've got some pretty tight height restrictions on what they've done and going up in unit blocks, etc. So the freestanding housing market, as well as the villa and unit markets in that closer inner city and more coastal lifestyle areas, has really performed well. And we're talking interest rates as well as gross yields are really helping out investors in that market. We're talking gross yields in some properties we've secured for clients there of upwards of 7 or 8% and growth of 10 to 15% over the last year or 2 years, and quite low entry level as well. So I think we're going to see a nice sustained growth cycle and period for Hobart, and I think they've probably got a good couple of years left in them. However, over the long term, they will no doubt probably be subject to more sudden changes and sudden shocks to that market. So I wouldn't say that I would want anyone to be loading up their portfolio in Hobart just because it's cheap or just because it's good right now, because I think you're going to see good and bad years out of Hobart rather than a good sustained linear growth market. And if I look probably lastly or second last in these markets at Darwin, personally I see Darwin has just never had really, as opposed to probably a couple of good years out of the mining sector, it just hasn't had what I would personally say is that the ongoing strong demand and also diverse economy that's going to allow a good sustained investment market, or even just a property market in general for investors to probably be playing in. It's seen a very flat 5 years, and I think we're probably going to see a good flat 5 years for the next 5 to 8 years as well, because nothing really seems to be changing out there. There's a couple of bigger markets, there's probably a couple of bigger announcements from infrastructure and jobs creation. However, they just don't affect the broader markets enough to really show that they're going to have a true impact on the broader housing environment. And the economy, as well as the net migration as far as population growth, doesn't look like it's going to help that market anyway. That's going to probably see it go on a long and strong population growth trend over the next 5 years. So yields are good in that market. They most certainly are on average sitting that 5% plus. So you're getting good return on your cash. However, obviously, again, we're not investing for that cash in general. We're really trying to get the cash flow in that market is what hopefully was always going to allow you to hold that property through growth cycles. But I just don't think we're going to see strong growth cycles anytime in the near future, unfortunately, for that Darwin market. So personally wouldn't be in my top 5 picks. And if I see lastly in our nation's capital in Canberra, we're probably talking at this stage probably at the top end or close to the top end of a good strong growth cycle, and I think it's seen a couple of relatively flat months come out of start of 2000 or mid 2017. However, the yields are pretty tidy. The economy's strong. We've got the highest income per capita of any market in the country. So I think over the long term it'll be a good solid performer. I personally like that probably slightly outer inner city market all the way through to the middle ring market, so that sort of 7 to 15k market in the freestanding housings. I don't necessarily like the numbers that we're seeing from some of the off the plans, as well as probably some of the additional supply coming to that townhouse and unit markets in that inner ring. I think there's probably a bit too much coming through that market there, and it's been quite soft. Apologies. However, I think the freestanding housing market is a good market, and it could be a good sustained market over probably the long term, but really focusing on properties which don't necessarily have much of an impact from being fringe properties and on markets where you can obviously build out and developers can go and grab the next piece of farmland and release it as that demand increases. So close to the infrastructure, finding areas on the light rail in Canberra is also a good ploy, and I think they're markets that will probably do well over the long term and sustained. Cash flow is good, relatively high cost of entry, but good sustained incomes, and population growth is going to be okay, but I don't think it's going to be sensational over the next 10 years. So I've probably given, I'm not going to probably belabor this map too much, but what I'll do is I'll bring this up in its entirety so everyone can see this particular map itself, and probably if I look at how this is going to affect, and I've probably given this overview from the previous slides, is that I'll go through Melbourne in particular on the current overview of that market, but I won't belabor, as I've said, I've gone through that detail a fair bit at the moment, but Melbourne being a bit of a fluctuating period from the data we see, and there's a large amount of supply in obviously the apartment market, so we're not necessarily that enthused about the high density apartment markets. The 2 to 3 unit, 3-story red bricks, I think, still perform well, but a lot of additional stock going out on the western fringes. And again, as part of where we see it in its growth cycle, I think Melbourne in particular is probably not ideal from us to say get in there here and now in general. Sydney, very similar. I think it's gone on a very strong tear. And I think we're at the point now where Sydney's going to probably see a good long flat sustained period. Yields need to catch up, and investors need to see better return, because if they're not getting the capital growth, they're going to want to see cash flow, and at the moment they're not going to see cash flow, and I think the capital growth is probably just past its peak. APRA and the pressures on the bank, I personally don't see that we're going to get much more growth over the next 3 to 5 years. So personally, unless you've got a very good reason to get in that property in Sydney, I don't think it's the right time here and now, unfortunately. And probably lastly on this page, Queensland, and in particular Brisbane. As we've said, I think there's 2 markets in particular there, and they're very diverse. The apartment market is a no-go in that inner city, and I think, again, if you're focusing on that apartment market, that's not the place for me to put my money. I think there is far too much supply, and there will be too much supply for the next 2 to 3 years. However, I think that the housing market and freestanding housing market in certain areas are going to perform really quite steadily. I don't think they're going to have stellar years of 10, 15, 20% growth over the next 5, 10 years, but I think we're going to see in certain markets close to infrastructure where the population growth numbers are really projected to do really well, and along the lines of where schools, transport, and a lot of the future investment into infrastructure is concerned, both North and West Brisbane. I think we're going to see some relatively sustained years and good cash flow as well, which is good in an increasing monetary costing environment as well. Apologies. If we look at the other parts of the market, and we've already obviously gone through this, but in particular Hobart, I think the freestanding housing market across Hobart is going to do well over the next couple of years, and I think it has already done well over the last 12 to 18 months. I'd be very selective, however, because Hobart is a fluctuating market, and I think you really need to make sure that you've got some good, clear ideas of what makes sense and what doesn't make sense in that market, and know that market in detail, because it's a very fluctuating market as far as the owner-occupier versus the rental demand in certain suburbs is not necessarily as clear-cut as a lot of the other major cities, and having some good in-depth local knowledge is key with Hobart to be able to get it right, in my opinion. So I'd say I'm happy with it, but proceed with caution at this point in time, because there are certain markets with probably better numbers than others and better vacancy rates than others as well. If we look at Adelaide, personally, again, I think the markets in Adelaide which will have good sustained performance over the next few years will probably be those more in demand, probably higher middle to higher higher probably population growth, as well as high affluency. I should get to. In general, they're the markets which I personally see are probably going to be the decent performers, from Glenelg down that coastal market in the east, probably towards the city. I think there's a pocket in there over towards the Port Adelaide areas, which will do okay. I don't necessarily like the fringe markets, even though they're cheap and the yields look like they're providing 7 to 10% gross yields. I think there's going to be some very, very high vacancy rates and some very soft employment areas coming out of that over the next 3 to 5 years with some of the certain economic factors. So I don't necessarily love it. So for me, it's a proceed with caution type of market at this point in time. And we've talked about Perth being probably right now being at very much the bottom of its market and plateauing to a degree. I don't think it's necessarily turned a corner yet and showing green shoots that are going to be booming anytime soon, but I do think there is definitely value in that market. Now, you can get in now, or you could hold off 12, 24 months and probably wait till things start to probably more so get on the improve, and I don't think you'll pay any much or too much more potentially in that 12 to 24 months if you do choose to hold off a little bit. So I think there's opportunity coming to that market, but I don't think necessarily you're going to miss out if you don't jump in the next 3 to 6 months. And probably lastly, lastly, I'd say Darwin. Again, we're not necessarily that enthused. I think the population growth as well as the jobs demand in that market are just not going to be providing much in the way of housing growth or affordability changes over the next 5 years. And I think they've got not necessarily big headwinds, but I personally don't see that there's going to be much that's going to change in that market to be able to allow it to really get on any strong growth trajectory over the next 3 to 5 years, unfortunately, for that Darwin market. And probably lastly, Canberra, as we've said, We're looking at highest incomes per household. We're talking sort of close to $150,000 per household average incomes there. So good, strong incomes, strong jobs at the moment, stable jobs, given the current federal government employment factors. But I think there's going to be better markets there that'll perform in that freestanding housing markets, that sort of slightly edge of the inner city all the way out to the middle tiers, and on the edge of the middle tiers, I think they're going to be the higher in demand freestanding housing markets on that older property of that sort of 15 to 30-year-old, potentially up to 40 years old brick freestanding single stories. We're still being able to chase 4.5-ish% gross yields, so not horrible yields, but good, strong, probably consistent growth is what I see coming out of that ACT market over the next 3 to 5 years again as well, but possibly not that that attached market of the housing, or sorry, the apartments or the townhouse markets on that inner city. I think there's probably a bit too much stock coming to that market that has over the last few years. So, look, I promised everyone that what I'd probably do is try to give you an overview of the fundamentals and what's happening across the market. So I hope I've given you a good rundown of the 7 fundamentals that we look at when we're buying property in any market, and they really are the key fundamentals that need to be focused on when buying property, in my opinion, in any market, whether it be your first or your 50th property. If you're not focusing on those, you kind of, I personally would think that you're probably not giving the full opportunity to understand where you can get the best amount of growth, as well as where you might also buy in markets which are probably past their prime or not going to give you the growth you'd want, as well as the cash flow and the demand and the vacancy rate. So I'll just share with you quickly as well some recent successful investment examples that we've bought for clients in different markets over the years. And I won't go into too many nitty-gritty details, but these probably show different property types at different markets that we've been able to achieve different results for different property types. So if I look at the first one here being a property in Campbelltown in New South Wales, which is a Western Sydney market, was bought quite a number of years ago. Actually, it was bought in 2011, I believe, 2012, somewhere around that. The property was purchased, I believe, for around about that mid-250s. There was a granny flat added to that property around about 2 years after that. It was a corner block in a market at the time which was quite depressed, but there was some good green shoots of population growth, the changing economy at around about 2011. There was some good demand at the moment at that time as well. At this point in time, that property brings in $380 a week. The granny flat, which was built and constructed for $85,000, so they're all in for around about that $320, $330. The granny flat brings in around about $335 a week and 11% yield, which is sensational. The current value, probably most importantly, is $700,000 on that particular property, and that's gone through a very, very good, strong, sustained 5-year growth trajectory. And we bought that property right at the start of that growth cycle, and that's the important factor. There's a little picture of that property. It's a cottage. The granny flat's to the right-hand side of it, but a good property that's sustained, very low maintenance, and easy to rent out, walking distance to train, rail, shops, etc. At that same time, we were buying properties probably in more of the affluent blue chip areas. This particular property was a unit in Cronulla. This was a standard walk-up 3-bedroom brick property, and that was purchased for $585, 2014. Rental income of approximately $700 per week, which is around about a 6% gross yield, which is still very tidy. And again, current value of that property sitting around about that mid-9s. Now that particular property there, again, a 3-story red brick walk-up, walking distance to train, and a few other aspects, which is a very sound, simple investment. And I think from my side of things, it comes down to understandable at the time. It still made sense. The rental yield wasn't $700 a week at the time. I believe it was around about that early 6s, but it was still around about that 5% gross yield. Good growth, just as at the start of the growth cycle in that 2014 timeframe, but has performed very well, and that owner still owns that property and has done very well out of the equity which they've reinvested as well. But a different property type at a different time as well. Some more recent property purchases. This property here, particularly in Ipswich, in Brisbane, probably a lower price point for a different client. More of a set and forget, low cost, low issue house, which was a 422, 600 square metres. Strong rental demand, again, walking distance to rail, as well as the town centre. Cheap purchase price at the time, 2015 it was bought, which is probably just at the start of the growth cycle there. And we're talking $325 a week rent, strong yield on that property, current value $325, so it's actually performed quite well. It's a very simple, as you can see, picture as you can see in the picture, they're a very simple property to understand and very low as far as maintenance is concerned, and it's had some good growth over the last 3 years, and I think we'll see some good sustained growth over the next 3 to 5 years as well. Another property we've picked up in a different market for a different client for a different reason was a freestanding house in Berrydale in Hobart, actually, and that's probably more of a part of the affordable corridor, 15 minutes from the CBD in the north of Hobart. Again, a 311 house, very simple, established. It was a mortgagee purchase. We were actually the only people at the auction. We put one bid in. We ended up getting passed in, and we renegotiated that purchase price of $198, and that was early last year. It was rented at $300 per week, and I believe that property is actually rented at $315 a week now. And it's also been revalued at $250,000 early 2017. So we're talking 26% capital growth in the best part of a year. And I think part of that was obviously part of the purchase price was very, very sharp given no competition. And also there's been some good growth, probably around 10 to 12% growth in that particular market over that last year as well. But again, you can see that in the picture of that property, a simple property, easy to understand, set and forget in that sense, but located well and fit that particular client's objective. They wanted cash flow, they wanted something low maintenance, they wanted something in a relatively low price point, sub 250, and they've achieved a very good result there as well. If we look over to what we've done in Melbourne, and I'll just one indicative example of something recently, we bought a freestanding house in Laverton, which has performed very well. That particular house had a secondary dwelling, which has now been rented to a second member of that family, 580 square metres. Again, it was an off-market purchase, which is obviously where you get the opportunities and the better opportunities in those particular markets. That was bought in mid-2016 for $425,000. Rental income combined house and bungalow was $515 a week. So again, a good tidy yield and probably one of the better yields we've achieved in Melbourne. Current value of $515 around about a year later. So we're talking $80,000 to $90,000 in equity found. And I think part of that again was due to the fact it was an off-market purchase. We bought it below market value at that time. It really was quite a strong market, and it's gone through some more strong growth. I think that's probably past its prime. We're not buying in that market anymore, but I think they're good opportunities that allow them to get good returns from a cash flow perspective, but also good, strong growth. And I think over the long term, those types of markets, close to universities, on the train line, as well as on the highway corridor into the Melbourne CBD, call it 25 to 35 minutes, good, well-located properties and quite affordable for those owner-occupiers as well as investors. And I'll probably share just the last type of property that we bought recently. Apologies. In Brisbane, actually, this was more of a North Brisbane purchase, Marumba Downs. This was a relatively sound house, but again, this particular client was looking for something that they could potentially add value to down the track. So this was a 1,200 square metre block with a side access. It was actually a deceased estate, again, an off-market purchase, but there's an opportunity with this property to subdivide one into two lots, keep the existing house and create a new 600 square metre lot straight behind that property. It was purchased for $465, rental income of just the house as it stands by itself of $480 a week, which is very tidy. And again, current value, and the actual vendor on this property received an offer before they even settled of $510, which was a fantastic result. So essentially they could have on-sold that particular property and made a tidy profit of probably 20 odd grand after all fees and charges, etc., without essentially doing anything. But I think that aside, that is not their intention. They didn't take the offer. However, their intention with this property is realistically, as you can see the picture there, is probably to create a separate driveway down the right-hand side of that house and create the second battle axe property and build a property at the back and keep both and essentially have a very good, sound, well-located property. It was about 3 minutes from a local train station. It's going to be about 5 minutes from a university. It's going to be built, so a good in-demand market, relatively low price point, but also future opportunity. So there's all different types of examples there of properties we've purchased for different clients in different markets over the last 4 to 5 years. And I think it was worthwhile just showing what are some of the types of results, but also what some of the types of properties that we can focus on. And again, each one of these properties were probably purchased for different reasons, for different clients who had different objectives. And that's the key, is you need to understand what you're looking at doing, and it needs to fit your position, both your financial position but also your objectives. And the same property for one person might not be the right property for another, and that's key, is understanding what you want to achieve before you go out and actually buy that property, and then secondly, layering in those fundamentals that we've discussed to make sure you maximise that purchase at the right time and also fits your objective and your portfolio. So at the start, guys, I spoke about the fact that I'll give you an overview of the fundamentals that we focus on when buying property, and I'll walk through those 7 fundamentals and gone into some detail of the market in general. And I've also walked through some examples of properties that we've purchased for clients over the years and how they've performed and how they probably fit certain criteria more specifically. So I also promised you that I'd go through what we do as far as our process is concerned. So I'll walk through that quickly because this is quite important. I think this is, even if you essentially want to take this information and run and do it yourself, which is great, I think really understanding what we do and how you can apply that to yourself, you might want to do it and also just assess your own position using this process itself. So initially what we always want to do is consult. And apologies, the purpose of that consultation is to really consult and in order to best understand your current position, your objectives as well, and that ensures that you set up the best mortgage structure, tax structures. We don't do that in-house. We also make sure that you utilize certified experts and get the right advice there and the right independent advice, not necessarily advice that's going to be pushing you into a particular product. And making sure you have those structures and those objectives set up before you invest is very important, and that's something we focus on in those early stages of that consult phase. And then the second part is to make sure you're educated, and obviously by logging into this webinar and going through this is a big part of that education process, but that is really what you want to ensure you're doing, is gaining education, and obviously hopefully this is part of that education, not only once you buy that property, but ongoing. You should also reassess, reevaluate your strategy, your objectives, what your borrowing capacity is, what your tax structure is, where the best markets are to buy that next property, and layering in all these different facets is something that we try to do ongoing with our clients, and that's a very important factor, and it should never be lost as part of the process of being I guess, a successful property investor long term. Obviously a big part of what we do, once we understand the fundamentals of what clients want to be looking for, their price points, what is going to suit their specific strategy and objective, we go and source and negotiate that property for our clients. Now, that's utilizing a wide range of research data that we've explained a couple of those aspects in this webinar, but also we have a lot of tools that we use in the back end as well. And that really is to focus on markets which are going to perform as per what we want to buy at, certain price points, certain locations, certain property types. And we source and secure those properties. Predominantly they're off-market purchases, and realistically our job is to get those properties below market price as well, and that's what gives you that instant kick of hopefully opportunity in quicker equity gains and better long-term results. The fourth part, which I think every investor should have, is support. Now, whether you have this as part of friends, family, but I'm probably more so thinking along the lines of professional advice and support, and giving you the ability to pick up the phone and ask questions about property types, your portfolio, the structures you should be buying in at any given point in time. And we're exclusive buyers agents and focus on the buying side of aspects, but we also work with a host of experts in the accountancy field, financial planning field, mortgage broking field, conveyancers, depreciation schedule, quantity surveyors, insurance quotes, etc. You need to make sure that you've got the right team of people to give you the right advice, and also hopefully rebound any ideas, thoughts, and changes to your objectives as well. And that's something that we try to make sure we're providing ongoing, is that ongoing support, and also just a mentor and a partner throughout the process. Very important. If you don't have it, my personal preference is to say find the right people that you can get that access to and utilize them and stay with them, because you want to be hitched towards people who have experience in property investing and have done it well and have results, because they're the people who hopefully are going to be the ones who are saying, I've been through it before, I understand, and here's what you need to think about doing for the next step, rather than probably taking advice from people who maybe haven't been through those motions before, or even if you're starting out, potentially just relying on your gut feel or what your mum and dad told you. As much as they might have good advice across the field, sometimes when it comes down to things they haven't done before, it's probably best to get the advice of the experts. And probably the last process, which every property investor obviously intends to do, is repeat. And repeating the purchase cycle and making sure that the first investment or the next investment is also an investment that's going to allow you to propel yourself to the second, the third, the fourth, the 8th, the 15th or 20th property, whatever your objective and also your total exposure objectives look like. And that really comes down to being probably as well versed as you can in buying the right asset at the right time, getting as much growth out of that property in a quicker period as possible, but also being able to re-leverage that equity in the right structures. So that comes down to the right mortgage structures, the right taxation structures, and then buying the next property which is going to fit the right piece of the puzzle for your portfolio, because a lot of people buy properties next door to that same property or near where they live because obviously they're familiar with it. But as we've gone through these fundamentals, it might not well be the best market to buy in or the best property to buy at that particular time. And that's what's going to allow you to leapfrog and also obviously get on that ongoing purchase process, which builds a portfolio of one property through to 10, through to 15 properties and ongoing. And that is really the important part, is that the first property needs to be the right property, the next property needs to make sure it fits the objectives and also is bought into that right market, and ongoing, that process should never change. So that's hopefully a good overview of what we do personally and how we do it. And that is something that we'd like to always make sure we're focusing in on when it comes down to how to make sure you're maximizing and getting the best profits out of any property in any market. And hopefully, guys, from my side, I hope you've achieved a lot or gained a lot from those 7 fundamental research aspects of what goes into making sure you get the right properties at the right time in the cycle, at the right price, and also focusing on the right structures accordingly. So again, this is probably the page I'll leave you guys with. If you do want to get in contact with us to discuss what we do and how we do it, you can catch us or reach out to us pretty easy. We're Pure Property Investment. Our office number is 1300 98 54 28. You can also drop us an email at inquiry@purepropertyinvestment.com, or you can check out our website at w.purepropertyinvestment.com as well. There's a lot of free education we try to provide, videos, blogs, updated blogs and vlogs on our website as well, guys. So it's a good source of information, and you can also log into our top 50 suburbs page, which also gives you a good access of a PDF of the top 50 suburbs that have grown over the last year and a bit. We usually update that on an annual basis as well. So that gives you good access to some again ongoing free education, and you also jump onto our newsletter, which we try to provide updated information on the market and how it moves. But look, it'd be great to for you to reach out to us and have a chat. We can set up a consultation that's always obligation free to talk about your position and how we might be able to help with you, or even just generally talk about any thoughts, questions you might have about property investing in general. So guys, I hope you got as much as you could out of that, and use it for what it's good for. It's good free education, and also look, we're always here to help, so feel free to contact us as and when you're ready to go. Okay, cheers, have a great day.